Why will 90% of people miss the next Bitcoin move? Not because they're stupid, not because they don't work hard, not even because they picked the wrong coin. They'll miss it because they're looking at the wrong thing. And 2026 is setting up to become the biggest wealth trap in crypto history. Most people think the trap is volatility. It's not. The trap is psychology. It's timing. It's narrative. It's the illusion that you're early when you're actually late. And if you don't understand this now, you'll watch the next major Bitcoin move happen from the sidelines. Again. So today, we're breaking this down. Why 90% will miss it, what's actually forming behind the scenes, and how to position yourself before the crowd even realizes what's happening. Let's get into it. Point number 1. The crowd is waiting for the wrong confirmation. Every cycle, retail investors wait for confirmation. They want headlines, they want CNBC talking about Bitcoin daily, they want their friends asking how to open a Coinbase account. They want price above the previous all-time high before they feel safe. That's the trap. By the time something feels safe in crypto, it's usually expensive. Look at 2017. Bitcoin ran from under $1,000 to nearly $20,000. Most retail didn't enter at 2K, they didn't enter at 5K, they entered when it was already vertical. Then 2021, Bitcoin broke 20K. Institutions were announcing buys, MicroStrategy, Tesla, nation-state conversations. Retail said, now it's real. And they piled in above 40K, 50K, 60K. What happened next? A brutal drawdown. Now fast forward to 2026. Here's what most people are doing right now. They're waiting for clear macro certainty, rate cuts fully confirmed, inflation under control, no geopolitical risk, Bitcoin holding above prior highs. They want perfect conditions. But markets don't reward comfort. They reward conviction during uncertainty. Bitcoin, as a decentralized digital asset secured by blockchain technology, was born in chaos, the 2008 financial crisis, distrust in banks, monetary expansion. It thrives in confusion. Yet people want clarity, so they wait. And while they wait, the move starts quietly. Not with fireworks, not with TikTok influencers screaming 100x, but with slow accumulation. Whales don't wait for confirmation, they create it. On-chain data consistently shows this pattern. Long-term holders accumulate during boredom. Short-term traders chase during excitement. Guess who wins? If you're waiting for 2026 to feel obvious, you're already late. The next move won't ring a bell. It will feel uncomfortable, and that's exactly why most will miss it. Now let's go deeper. Point number 2. The 4-year Bitcoin cycle is misunderstood, not broken. You've heard it before. The 4-year Bitcoin cycle is dead. People say this every single time price behavior shifts slightly, but here's the reality. The cycle isn't magic, it's structural. Bitcoin's supply issuance is coded into the protocol. Every roughly 4 years, the block reward gets cut in half. That's not a theory, that's math. Less new supply enters the market. If demand stays the same or increases, price adjusts upward. Now here's the problem. Most retail investors treat the halving like a calendar event. They expect instant upside. They buy 2 weeks before, nothing happens. They get bored. They rotate into altcoins. Then, months later, Bitcoin begins grinding up slowly. It doesn't explode immediately. It squeezes liquidity. It climbs a wall of disbelief. And people say, I'll wait for a pullback. In 2026, many will say the cycle doesn't apply anymore because institutions are here, because ETFs exist, because the market is more mature. But maturity doesn't eliminate human behavior, it amplifies it. Even institutional money follows liquidity cycles. Liquidity expands, risk assets rise. Liquidity contracts, risk assets fall. Bitcoin just happens to be the most volatile expression of that reality. The trap in 2026 won't be believing in the cycle. It will expect it to look identical to 2017 or 2021. Markets evolve. The moves become more complex, more fakeouts, more range-bound periods, more emotional exhaustion. That's how they shake people out. You won't miss the next move because it didn't happen. You'll miss it because it didn't happen the way you expected. and expectation is the enemy of positioning. Now let's talk about the biggest trap of all. Altcoin euphoria will distract you again. Be honest, how many times have you told yourself, I'll rotate back into Bitcoin before it's too late? And how many times did you actually do it? Altcoins are seductive. They move faster. They promise 10x, 20x, 50x. They have shiny narratives, AI tokens, gaming tokens, layer 2 scaling, real-world asset tokenization, meme coins that feel early, and some of them will explode. But here's what most people don't realize. Altcoin seasons typically happen after Bitcoin has already made a major move. Capital flows from Bitcoin to Ethereum, from Ethereum to mid-caps, from mid-caps to small caps, from small caps to pure speculation. Then the music stops. The problem, most retail investors enter during phase 3 or 4. They see a token up 400%. They think they're early. They aren't. They're exit liquidity. In 2026, the narrative machine will be stronger than ever. Social media cycles are faster. AI-generated hype, bots amplifying tokens, 24/7 content. You'll feel like everyone else is making money except you, and that emotional pressure will push you out of disciplined positioning. Bitcoin may be consolidating, slowly grinding, building structure, but your feed will show someone turning $1,000 into $50,000 on a meme coin, and you'll question your plan. That's the trap. Wealth in crypto is often built in boredom and lost in excitement. The next Bitcoin move may not look explosive at first. It may look like a slow squeeze, a tightening range, low volatility, quiet accumulation. Meanwhile, altcoins will flash green candles, and most will chase. Then, when liquidity tightens, Bitcoin dominance rises. Altcoins bleed 60 to 80%, and people say, I should have just held BTC. History doesn't repeat exactly, but human emotion does. Now let's go even deeper. Point number 4. Macro liquidity will flip before retail realizes. Here's something most crypto YouTube won't tell you clearly. Bitcoin is no longer isolated. It's tied to global liquidity, central bank balance sheets, interest rates, dollar strength, capital flows. When liquidity expands, risk assets benefit. When it contracts, they struggle. In previous cycles, many retail traders ignored macro. They focused only on charts. But in 2026, macro will be even more dominant. If central banks begin easing again, if real yields compress, if capital seeks asymmetric returns, Bitcoin becomes attractive not just ideologically, mathematically. Institutions don't buy Bitcoin because it's cool. They buy it because it offers convex upside relative to other assets. If bonds yield little, if equities look stretched, if currency debasement becomes a concern, Bitcoin's fixed supply narrative strengthens. But here's the key. Retail waits for headlines. Institutions position before them. They watch liquidity indicators, credit spreads, dollar index movements, bond market signals. By the time mainstream media says liquidity is back, Bitcoin may already be up 40%. That's the trap. You think you need certainty, but markets move on tapping in, and anticipation requires studying conditions, not waiting for confirmation. Now let's talk about something more uncomfortable. Point number 5, emotional fatigue will keep you out. This might be the most dangerous trap of all, burnout. Crypto cycles are brutal. Volatility, narrative shifts, FOMO, crashes, recovery, repeat. After years of this, people get tired. They say, I'm done. They move to safer assets. They stop checking charts. They emotionally detach. And that often happens right before the next expansion phase. It's like the market exhausts you intentionally. It creates just enough doubt, just enough sideways price action, just enough failed breakouts, so that when the real move begins, you're not fully positioned. In 2026, many investors will be dealing with psychological scars from previous crashes. They'll say, I'm not falling for it again. And caution is healthy, but paralysis is expensive. Bitcoin's volatility doesn't disappear, it compresses. Then it releases. And if you're emotionally checked out during compression, you won't be ready for release. Now let's zoom out. What actually creates massive Bitcoin moves? It's not hype, it's supply and demand imbalance. Long-term holders lock supply, miners reduce issuance after halvings, institutions accumulate through structured vehicles. Meanwhile, global liquidity ebbs and flows. When demand returns aggressively while supply remains tight, price has only one direction to go: up. But that move never feels obvious at first. It feels fragile, uncertain, too risky. That's why 90% miss it. They wait for comfort, and comfort comes after the move. So what do you do differently? Let's break this down into actionable perspective. First, separate narrative from structure. Narratives change weekly. Structure changes slowly. Bitcoin's fixed supply doesn't change. Blockchain technology continues securing trillions in value. Adoption trends continue expanding globally. Focus on the slow variables, not the loud ones. Second, understand capital rotation. Bitcoin often leads, Ethereum follows, altcoins lag, then overshoot. If you understand the flow, you don't need to chase every pump. You position early. You scale strategically. Third, watch liquidity, not influencers. Influencers amplify price. Liquidity drives it. Pay attention to central bank policy shifts, bond market trends, dollar weakness. You don't need to be a macroeconomist, just be aware. Fourth, build a plan before volatility returns. When price starts moving aggressively, emotions override logic. If you don't know your strategy beforehand, you'll improvise under pressure. And improvisation in crypto usually means buying high and selling low. Now, here's something deeper. The 2026 wealth trap isn't about Bitcoin failing. It's about you mismanaging exposure. Most people don't lose because the asset doesn't go up. They lose because they rotate out too early, or chase too late, or over-leverage, or panic, or get greedy, or compare their portfolio to strangers online. The trap is behavioral. Let me ask you something. If Bitcoin quietly climbs 30% over 6 months, will you be patient? Or will you get bored and chase something faster? If it pulls back 20% during that climb, will you panic? Or will you understand volatility is normal? If altcoins explode temporarily, will you abandon structure? Or will you stick to your allocation? These decisions determine whether you're in the 10% or the 90%. Now, let's talk about positioning psychology. The people who win big in crypto cycles usually do 3 things well. They accumulate during apathy, they hold during volatility, they distribute during euphoria. Simple, not easy. Accumulation feels lonely. Holding feels stressful. Selling into strength feels counterintuitive, but that's the cycle. In 2026, the wealth trap will convince people that this time is different, either too bearish or too euphoric. Extremes always cost money. Balance builds it. Bitcoin isn't just a speculative asset, it's a monetary network, a decentralized settlement layer, a hedge against systemic fragility. But it's also volatile, and volatility magnifies psychology. The next move won't be caught by the smartest, it'll be caught by the most disciplined. You don't need to predict the exact top. You don't need to time the exact bottom. You need exposure before expansion and a plan during acceleration. That's it. Let's zoom out one more time. Imagine it's mid-2026. Bitcoin has been consolidating for months. Volatility is low. Media interest is minimal. People are distracted by other markets. Then slowly, it starts trending up. No parabolic candles, just consistent higher highs and lower lows. Institutional flows increase. On-chain data shows accumulation. Exchange reserves decline. Sentiment is neutral. You tell yourself, I'll wait for confirmation. Price moves another 15%. You wait for a pullback. It doesn't come. Suddenly, media notices. Headlines return. Friends text you. You buy. Now you feel safe. That's the wealth trap, because safe entries in crypto are rarely optimal entries. The uncomfortable zone is where asymmetric opportunity lives. Bitcoin doesn't reward comfort, It rewards conviction built on understanding. So what's the real secret behind the 2026 wealth trap? It's not market manipulation. It's not secret insider groups. It's human nature. Fear of being wrong, fear of missing out, fear of losing gains, fear of looking foolish. These fears push people into reactive decisions, and reactive decisions compound losses. You don't need to outsmart the market. You need to outlast your own impulses. And here's the final reality. Bitcoin doesn't care about your opinion. It doesn't care about headlines. It doesn't care about your emotions. Its supply schedule is programmed. Its blockchain continues producing blocks every 10 minutes. Tick, tick, tick. The question isn't whether Bitcoin will move again. It's whether you'll be positioned before it does. In 2013, few believed. In 2017, many chased. In 2021, institutions legitimized it. In 2026, the market will mature further. But psychology will remain unchanged, and 90% will still react late. So here's your takeaway. Stop waiting for comfort. Study structure, understand liquidity, respect cycles, control emotion, position with intention, then let time do the heavy lifting. If this perspective helped you see the bigger picture, if you're serious about not being part of the 90%, stay sharp, stay disciplined, and make sure you're around for the next move. Because whether people realize it or not, the trap is already forming, and the window won't stay open forever.